Good morning, ladies and gentlemen. Hugh Robertson is my name. I'm here in my capacity as chairman of Credit Clear. Presenting our results will be Andrew Smith, the CEO, executive director and major shareholder, with, I suspect, Victor Peplow, the CFO. My opening comments are only this: it's been a tumultuous year we've been through. I think I can say and put my hand on my heart in saying the decks are clear, the bad times are behind us as a company, and this is a company that is ready to come down the straight in terms of performance. I'm personally delighted. I'm a reasonable shareholder with the way the company is continuing to gain really impressive momentum, which I think you can see in the report that's been released to the exchange today. On that basis, thank you, and I'll hand over to Andrew.
Thank you very much, Hugh. Once again, I'd like to welcome Victor Peplow, our Chief Financial Officer, and Jason Serafino, our Chief Product and Technology Officer, who'll be presenting the deck today. But right at the beginning, I'm probably going to echo some of Hugh's sentiments in the fact that it's been a very tumultuous year, one filled with significant changes to capital markets, a major acquisition in Armour Group Holdings in February this year, and some pretty big changes across the group where we had to tighten our belt and bring some additional discipline in. And I'm extremely proud that, to finish off the year with two profitable months and be starting this financial year with what it looks like to be two profitable months. I know it's the last other month today, but is a real sign and a testament to the work that not just the senior leadership team's done, but across the whole group in terms of responding to the needs and the changing markets. So first and foremost, I just wanted to thank my team and look forward to the future and have a little bit of a look back in terms of some of the highlights and where we're going in the future. So let's move forward. So just some investment highlights across the group. Growth in revenue of $21.5 million, which is up 95% year on year. Monthly revenue set in June with $3.1 million in total revenue across the group. Really excited to see this not just being a lumpy result, but one that is indicative of month on month. And what we're seeing as we move forward is each month is looking like to be a record month. So as we move into completing August today, I'm very excited to say that, August should be another record month. Not only growth is important, as we know these days, is to make sure you can have sustainable growth and growth with profit. And once again, very proud to say that, whilst we are growing considerably, we're doing it sustainably whilst maintaining operational profitability. And that came through in May and June, which is well ahead of our forecast, which we were hoping to do in the first quarter of this financial year. But to see it done early is just a testament once again to the way that the business responded when we made some call outs to bring some better discipline across the group, bring some focus on terms of margins and invest our money wisely. So seeing a 20% of additional revenue flowing to normalised EBIT was another encouraging statistic that is a highlight for me. As Hugh said, there's a real momentum shift in this business, and I think with the combined efforts of Armour Group and Credit Clear working as one on an end-to-end hybrid offering, what we're seeing is a huge take-up of customers, and that was demonstrated by 215 new clients added in the financial year of 2022. So with 99% client retention rate, what we're seeing is substantial growth, not just in revenue, but in expansion across clients. Encouraging is several of those clients added to the year expected to become top 10 clients. And in fact, one of them was our top billing client last month. So what we're seeing is not just additional clients, but some larger key clients across large financial services, business, insurance, and government sectors. So what we're doing is really pushing into that sort of top tier customer level, and that's delivering substantial revenue growth for us. Whilst we've been growing, our investment in technology has continued, and I'm very, very pleased to see that we've been able to deliver 35% uplift in collections across the group and surpassed over 100 million in digital payments through the platform, which is a particularly proud milestone for Jason and the team. And this was recognised once again this year at the FinTech Awards, where we backed up our win from last year in the best use of artificial intelligence via FinTech. Now, that was also supported by a nomination and a finalist position in the ANZIF InsurTech Awards, where Credit Clear was recognised as a finalist for the work we're doing specifically within that insurance industry around the InsurTech solution, thanks to some of the work we do with our major insurance clients. Now, there's been lots of changes in our industry, not just in terms of capital markets, but in terms of service providers in the accounts receivable and the debt recovery space. What we've seen is some really big changes across the group. And that's given huge opportunities to us as a company. But where we've seen the greatest growth come from ARMA and Credit Clear is where we've used an end-to-end offering, where we can offer our clients a solution, not just at the early stages where digital is very, very prevalent. What we can do is offer hybrid solutions across all stages of that customer accounts receivable life cycle. And what you'll see is that digital plays a very strong part early on in the piece and during the mid and late stage collections part. But as long as we've got some people in call centres to support that, what we're seeing is a huge uptake from customers in the utility space, in the banking and finance space, in the buy now, pay later space, because what they need is not just a digital solution that solves issues for clients when they are struggling to pay a bill or they've misplaced their bill. What they're seeing is that when there's someone they need to speak to, we've got the resources and the people who are trained to take those calls and actually solve that issue in an analog way. So that's been one of the greatest momentum shifters for Credit Clear as a business, and really driven that exponential growth as we start this financial year. As I alluded to earlier, there's been some pretty significant changes in this market. As I've mentioned in many of these presentations before, COVID's done some pretty incredible things in stopping a number of credit providers no longer selling debt. The likes of Westpac and Telstra, they made the decision to no longer sell debt to those large debt buying businesses like the Credit Corps of the world. And what we're seeing is an increase and expansion of our total addressable market through clients looking for partnerships with contingent service providers to assist with these challenges. So a couple of call outs. The digital-only providers have struggled to gain traction. Clients need people to have some support if their clients can't solve those accounts receivable challenges through digital means. It's essential, like what Credit Clear have, is to have a locally based call centre to be able to support those clients that need to speak to someone. As I mentioned, debt purchasers competing for a shrinking pool. Not only that, there's been some pretty significant write-downs on the value due to some changes in obviously economic conditions with interest rate rises and certain inflation and relatively negative effective wage growth. So what we're seeing is that the performance of those debtor books aren't quite as good as what the modelling said when they acquired the debts maybe 2 or 3 years ago. And we've actually seen a large consolidation from some of the large contingent debt buyers. Milton Graham recently announced a merger with Recoveries Corp, who are 2 of the largest contingent agencies. We've seen Credit Corp recently announced the acquisition of Collection House, who were in administration. So what that means for us is that there is less choice for those large credit providers to solve those issues, but the problem is getting bigger. So what I'm saying is that, that's created some very, very good market conditions for us to take to the future and leverage for growth. Socio and economic providing tailwinds as well. Certainly, everyone would recognise that the debt levels within the average household are increasing. that, the average mortgage repayments have been going up significantly for the last 3 months, and likely to continue, that inflation's at the highest rate it's been for a long time, whilst unemployment still sits at record lows. So look, those market conditions are probably some of the best market conditions for Credit Clear to operate in, where whilst people may be struggling to manage their bills, having an easy solution like Credit Clear to do it with is actually a very, very encouraging opportunity for us, and what is driving a great part of the growth within our sector. Now, here's a little look back on the revenue over the last few years. As we recognise, the acquisition of Armour in February this year has driven a great proportion of that revenue. But what it doesn't highlight is the massive organic growth that's happened since that point. As I said, one of the customers that was signed since that acquisition is, in fact, our largest client from a billing perspective last month. So what we're seeing is the two companies coming together and a huge amount of additional opportunities flowing into that business. Probably one of the things I'd like to call out is to say, without that combination of having Armour as a trusted service provider, utilising the market-leading, award-winning digital technology like Credit Clear, we wouldn't be in the position we are in terms of on the precipice of winning some major work with large banks, major utilities and government organisations. And they're types of businesses that we really want to be working with. So what we're seeing is that this momentum shift has really started whilst bringing the business back to profitability. Just a few more operational highlights. 696 active clients. That's 118% up year on year. We continue to set the bar very high from a net promoter score. And in almost 100,000 respondents that have used our platform to make a payment, the average net promoter score is plus 47. So that's quite extraordinary to think that through the process of recovering money from an overdue account, that we could experience a plus 47 net promoter score is quite extraordinary, and one that continues to surprise our clients. Having over 842,000 transactions this year, which is up over 61% year on year, is once again a demonstration to the growth within our group. And having a 99% recovery rate, 99% client retention rate is clearly an indication that once we win a client, it's a very strong likelihood that they'll continue working with us. We continue to add to our total files under management with 831,000 total active customers under management. That's 127% year-on-year growth. And where we look to the future, we've got $63 million worth of total payment arrangements committed through payment plans within the business. So what we're seeing is all the indicators that I'm looking at for future success are really heading in the right direction. And that's coming off a baseline of profitability. So it gives me great excitement to move to the next slide and start to talk about what we're doing from an international expansion perspective. Now, many of you may have read the releases, but Lewis and I went on an international expansion trip for almost 2 weeks. Some might have thought that Lewis and I being on a trip together for 12 days, we might have come back strangling each other, despite the fact many of you Hot Copper followers thought that there might have been a rift between the two of us. What I'm pleased to tell you is that it brought us much closer together. And what I come to realise is that there's no one more passionate about Credit Clear than Lewis. He bleeds Credit Clear, and his strengths really lie in breaking into new markets. That's what he did in Australia, and that's why we've appointed him as head of international, because he really thrives off that challenge, those early stages of startup where you have to break into new markets. And that really came across in the time I spent with Lewis. And I was very, very proud to come back and recognise that he's perfect for that position for global expansion. Now, the first place we visited was South Africa to see our partnership with Tech Hub, and some of the incredible work that not only the Tech Hub team, but certainly the Credit Clear team had been to build a solution that's now working in that region. Look, whilst our expectations could probably have been that we'd want to see that moving quickly. In hindsight, to have built a fully deployed digital solution through a partnership in less than 6 months and having operating was an incredible achievement. And all I'm going to say is the commitment from the South Africans when we visited them was very, very clear, that they made the statement that this has to work and they're going to put everything into it to make it work. And we matched that commitment, and we're going to work forward to try and drive future revenue through that platform together. The second region we visited was in the UK, where we had an opportunity with a large multinational business processing outsourcing business and collection agency. Once again, this is a discovery meeting, and what we found was that the progression and the development of automated digital collections in the United Kingdom was probably less advanced than what we had thought. There was less operators, less competitors, and what we had to provide and demonstrate was far superior to anything that anyone had seen when we were over there, which gave us a huge encouragement. And we left that region and the meetings that we were on feeling extremely positive about that, and the opportunity to add potentially a partnering and teaming basis or even a joint venture. So look, whilst it's at the early stages, it was extremely encouraging, and one that we had left with a bunch of commitments from not just collection agency that we met with, but also some large utility clients. So some exciting stuff going on in the UK. On the way home, we came back via Singapore and Southeast Asia. We had some meetings with some potential contractors who could scope out that region. And whilst Singapore didn't represent a particularly good opportunity for us, other parts of Southeast Asia look like they could be an opportunity in the future. In finishing that off, I think once again, Lewis is the perfect candidate for someone who can take Credit Clear internationally, and one that I'm once again extremely proud of in the way that he goes about passion of Credit Clear. And I look forward to what's coming from there. Now I'm going to pass on, I believe, to Jason.
Yeah, thanks a lot, Andrew. So let's talk about digital. And as we know, the proof's in the pudding. And so this is a really pleasing graph, actually. So this is a payments collected on the digital platform over the years. That's where we engage with customers, and then they complete payment on the digital platform. And as you can see, it's accelerating really nicely. So that's reflective of the increasing sales, new clients coming on board. It's also reflective of using digital deeper and deeper within our clients, within Armour and our clients. And that's often the case that we start with, maybe a relatively simple proposition as we bring that client on the journey. And, once they see the digital effect and they see this kind of 20% plus uplift, and they see a fantastic NPS, and they see fantastic customer commentary coming in, then they want to use it deeper and deeper into the life cycle. So that's reflective of that. It's really accelerating nicely. And in fact, if you look at the outlook for FY23, we're pretty bullish on it. FY22 only includes 5 months of Armour. And so we're seeing this last quarter as being a really strong quarter. In fact, May, June, July, August, 4 consecutive months of record collections on the digital platform. We had 2 of our top 5 best performing days in August alone. We'll hit 5 million in August. So, annualized 5 million would be, 60 million a year, which would be amazing. So really, really strong results coming through in digital. I'll also say as well, that this is quite a conservative way of measuring the digital impact, because this is only when a customer completes payment on the platform. But when we're engaging with customers, we offer the opportunity for callbacks, and often customers will choose to call in, and our call center teams love an inbound call with a customer ready to do something. So that's a really good outcome. And often we see that the effect of digital can be 2 to 3 times what we actually see on the platform. So it was a really fantastic achievement to see us pass 100 million in collections on the digital platform. Is really pleasing. To the next slide. So talking about pleasing results, we've got, as you know, we if you followed us previously, we love the scientific approach and proving what we're doing is working. I've got a couple to talk about today. I'll take the one on the right hand side there first, and this is a recent test that we ran for a commercial client. So this is business to business context, where we took their workflows and we basically accelerated. We took the digital workflows, and instead of running over a longer period of time, we shortened it. Sounds like a pretty simple change, right? But we saw a great uplift, conversion uplift of 15%. It brought in payments 67% faster. So even a small change like that can make a huge difference. And the call out here is, providing, as our platform does, empirical results that show you, the effect of each change is incredibly powerful. And that's how we can, ratchet up and ratchet up and ratchet up those results and better customer experience for all of our clients. So even a small change like that can make a huge difference. The real big call out, though, the exciting news, I think, is the one on the left-hand side. And as Andrew said already, a year ago, we won the best use of AI in fintech in Australia, which we were super excited about. And if anybody thought that was a fluke, we backed it up last week by winning it a second time, 2 years running, for the best use of AI in fintech. And I've got a case study here to explain really what does that mean, because I think we're winning these awards because of absolute concrete, money in the bank results that we're generating with AI. So in this example, we have a toll road operator, and what we did is it's a client that we've been working with for some time. We're very progressive in our hybrid workflow with them already, and we took their customers, we split them into 2 cohorts, and in one cohort we ran our full digital and optimized hybrid workflow. So that means sending SMSs, sending emails, our digital experience, plus our teams on the phone. But in a, I guess you call it a more structured workflow, where we kind of, maybe send digital communications in the first couple of weeks, and then we follow it up with phone calls if they don't pay, which would be market best practice. The contrast is in the second cohort, we did all of that, except that we had our AI. Now, our AI is using all of its prior experience of tens of millions of customer interactions, plus what that particular customer is doing through the process, to decide every day what to do next. So the AI might make a decision, for example, for this particular profile of customer, maybe it's a low risk customer, maybe they haven't done anything yet, we'll send them an SMS today. For this other customer, perhaps we've sent them an SMS, we've sent a follow-up, maybe we've sent an email, it's time for a phone call. And it makes very sophisticated decisions about that. So every customer's journey through the process is going to be a little bit different. So using our AI as the brains, we were able to demonstrate a 35% uplift in collections, right? That's a remarkable uplift and a really strong validation of the power of our AI and the difference that it really makes. So we're really excited about this. To the next slide. And back to you.
Thanks. I think it's over to me. Morning all.
Over to Victor.
Yep. Got 2 slides here, so I just want to cover a couple of key summary points year on year, as well as go into detail at the next slide, where I'll talk about normalised EBITDA, which I think is more reflective of business performance and what we've achieved over the last 12 months. Firstly, revenue growth already been mentioned, up 95% with all parts of the business performing well. We had digital revenue increase 53% year on year, and that was very well contributed to by the Yama Group, who came on in February, hit the ground running with clients ready to go with digital collections, which was received very well by their clients as well, with good collection results. Traditional increased 149% year on year. High figure again due to the ARMA acquisition. I'd like to think in 6-12 months from now, as ARMA convert traditional collections to digital, that digital will increase further given it feeds from that traditional collection pool. And legal recoveries also increased 50%, which is quite a pleasing result there. Already been mentioned that June was a strong revenue month with 3.12 million recognised. That's continued into the new financial year with quite a strong client pipeline as well, new clients that is. So when we combine the 95% increase in revenue with expenses, expenses increased 53% year on year. And that's where we were able to achieve the margin uplift, which I'll go into a little more detail for in the next slide. Obviously assisted by the increase in digital volumes, which Jason has just explained as well, given digital and technology collections, as we know, provides a higher gross profit margin. In terms of normalised EBITDA, and again, I'll explain what we're defining as normalised, on a pre-tech development basis, that improved 83% year on year to $500,000 loss. And including tech development, improvement was 32% to a $3.4 million loss. Again, Andrew's already touched on May and June being our first profitable months. And, that's where we consider the business to be at a financial turning point. We've got some good scale, revenues growing, we're containing expenses, and we can see profits continuing to improve from this point on. That combined with a strong cash balance of 10.2 million at year's end gives us a very strong financial footing to take this business forward. So what I've got on this slide here is working back from the reported EBITDA number that was disclosed of $8.5 million loss in the bottom left corner there. That was in the annual report that was lodged with the ASX this morning. Is not a true reflection of what's been achieved in the last 12 months. So what I'm doing here is paring that back just to get it back to a normalised EBITDA on a pre-tech development, which is the green row there, where you can see that year on year, the losses improved from 3.4 million to 572,000 loss. Okay, so that's the operational leverage we've achieved, and it's come from revenue above, which has improved 10.9 million to 21.4. Expenses have increased from 14.4 to 22 million, which is only that 53%, which compares favourably to the revenue increase of 95%. During the year, management also conducted a review on expenses where we were able to cut in excess of $1 million of our expense base with no impact on client service or tech development spend. And we continue to approach expenses in a very disciplined manner. And with that, we were able to achieve a 27% drop or increase in that normalised EBITDA line. And what I mean by that is for each dollar of revenue increased on the top there, 27 cents in the dollar was able to drop to that normalised line. And we expect that to increase further over the next 6 to 12 months, again, as we continue to convert from traditional collections to digital. And we're also, given the ARMA acquisition, that has created a duplication of systems, debt collection systems, hosting environments, and we're working through that currently, still early stages, to try and streamline and consolidate that infrastructure, which will provide us with further synergies as well. So I'd like to think that, that margin drop or that operational leverage will increase in addition or beyond 27% over the next little while. Tech development, we continue to invest in that area for obvious reasons. The three key reasons, which again, Jason's touched on, is high collection rates. And that's been proven by case studies now. So we've got the evidence there. We've got a better client experience in the form, which is measured in the form of a very favourable NPS score. And we're also winning new clients on our tech capability, and the sales team's coming back saying, look, our end-to-end hybrid model is certainly what clients are looking for, but our point of difference is that technology capability, the digital collections, which is what we think sets us apart from our competitors. And then we've got there what I've titled or described as abnormal items or non-operational type expenses. Again, just to put that year-on-year comparison into perspective, where last year, FY21, we did receive JobKeeper payments as well as COVID-related government benefits, which we didn't this year. Our expenses there for FY22, the $3.3 million, is largely to do with armoured DD related expenses as well as legal fees, some redundancies there, and some of that system rationalisation, which we commenced at the end of the year. And then share-based expenses there, which is largely employee options, which is how we came to an $8.5 million EBITDA loss. But again, I turn your attention to that normalised EBITDA number, the green row there, where which clearly shows the improvement year on year to that EBITDA line. And lastly, as I mentioned, cash we were able to retain at $10 million year on year. Thanks to Andrew.
Yeah, look, this is probably one of the most important parts of the slide, one that I've got to be a little bit careful in terms of what I disclose. I know that a lot of our competitors would be listening in on our presentation and really talking about the excitement and the worry associated with a business like Credit Clear disrupting this space. So whilst I'll try to keep it relatively low profile, I'm pretty excited about the level of excitement activity within our sales team. I don't think in my whole existence working in this sector of over 20 years that I've ever felt the amount of energy and enthusiasm from customers talking to us. And that's being already demonstrated by new client trials, new client opportunities, the number of presentations that we're having with major banking and finance institutions, telcos, utilities, and government. So what we're seeing is those really strong leading indicators for future growth. And that growth, as I predict, is going to be gradual growth, not lumpy. It's going to be gradual growth as we see each daily performance improve. And what we've seen over the last 6 or 7 months is each day we can really track the amount of revenue that's coming in across the group and watch it grow from an average in May to an average in August that's far exceeding, but slowly showing some good trends moving forward. And that's once again off the back of wonderful digital performance supported by what I think is best practice, analog offerings in the call center. So just a bit of a recap around strong revenue growth. Existing customers who were impacted by COVID over the last few years are referring more work, and the average size of those accounts have increased significantly. As I've mentioned before on a number of presentations, sectors in the essential services such as water, rates, electricity, they've been tended to hold on to their accounts much more likely over COVID. They're all being released to service providers like Credit Clear, and that's driving additional growth from existing business. As I mentioned, new client wins in FY22 have been adding material volume. And as I said, one of our, if not our largest client last month came from a new win. So what we're seeing is not just a high number of new clients. Those clients are actually in that sort of top level. What we see is going to be the top 10, top 20 customers across the group and really drive significant growth moving forward. And that's all leaning towards a really growth trajectory, which is accelerating into 2023. From a financial position point of view, once again, I want to call out the amazing work that the team have done to not only tighten your belts and cut out some significant costs within the business, but look at how we can improve profitability and margins within certain sectors, within customers where we might be making money, making sure we renegotiate those contracts. We look at teams that weren't necessarily adding value in certain areas and pivoting and changing their roles and responsibilities. And what we've seen, all that come together and deliver strong profitable months at the back of the end of financial year. And for this financial year, as I said, in July and August, it looks like we're going to start the quarter and the financial year with profitable months. Now, being able to reinvest in sales, so we can sustainably grow the business whilst investing in technology at the same time is going to be, the game moving forward, rather than continuing to invest in technology without necessarily tying that to a revenue stream is not what the business is about now. What we're about now is actually building technology, customizing that technology for our primary clients, and actually leveraging that technology to drive future revenue, rather than build the technology and then hope to sell it to someone in the future. And what we're finding is that means that we can actually attach additional technology investment to key customer integrations. And what we're seeing in the insurance space, in the financial services space, that we can actually build customized solutions, integrate within third-party systems, and really build strong partnerships with those organisations. So that's an exciting future outlook. I did speak about international expansion a lot, but I just want to talk about the commitment in South Africa. We've done a lot of work and effort in that partnership, built the solution. Now it's really time to drive performance out of that solution. And what we're doing is regularly meeting with that organisation weekly and building the sort of key ownerships within the business to those meetings, so we can drive commercial outcomes for both parties. I talked about the UK opportunity where there's a multinational BPO, which are very, very interested. We got a message last night in terms of wanting to progress that opportunity. So that's very exciting. And Southeast Asia, once again, very early stages. The new business pipeline's looking better than ever. There's some large client opportunities in the financial services space. There's a very large insurance opportunity that's looking very close. Multiple large utility opportunities in progress with growing pressure on customers due to high inflation. And the addressable market across the whole sector is growing significantly. So once again, I am sitting here feeling very, very positive about what the future looks like and very excited about how we can move into the future. So, as investors who have stayed with us, as new investors who are looking at us, that, maybe in the past we looked like a business that was potentially could have shot the lights out or ended up nowhere. What I think we are now is a really strong business with great fundamentals, with absolutely revolutionary technology. So you combine those two together, I think the outlook for Credit Clear is very strong, and that's one of the things that I'm going to take moving forward. Just a key point, probably what indicates the fact that the business is positioned really strong, is that there's a large number of stock coming out of escrow in October, when it's the 2-year anniversary of where we listed, and having questioned the board, who are significant shareholders of escrow money that's coming out in October. It was pretty encouraging to hear that every single one of those escrow holders or shareholders that were coming out of escrow all indicated that very strongly that they'd be holding onto their stock. So that's over 40 million shares that won't be hitting the market, which is probably good news to most of you, apart from the brokers. But what that really indicates is the people who know the business as well as anyone are committing to hanging on to the work. Finally, just before I throw it to the market, I just wanted to recognise Mark Casey and the Casey family. They're just going through a tragedy at the moment, and I just wanted to say, the whole Credit Clear family are thinking of you and your family. Mark Casey was a founder of Credit Clear. He's a major shareholder and also a board member. So I just wanted to make sure that everyone understands that we're supporting the family, and I suppose today was important to acknowledge that.
Thanks very much, Andrew. We've had a few questions submitted via email, so I'll go through those first. The first one, technology related, for Jason, just asks about the recent investment into onboarding, and if there are 3 parts of that process that needed improvement, what would they be, and what progress has been made so far? Yeah, sure. So well, first of all, scaling is a kind of nice problem to have, actually. So how do we cope with all the clients that are coming on board? But what we're investing is really, I guess you'd call it the administration functions. We know the core
platform proposition works really well. And what we're looking at doing is streamlining the processes of administering the clients. You know, we're dealing with larger and larger clients with, you know, complex integration requirements. So what we're looking at doing is streamlining the process to be able to configure the platform to be able to ingest those clients' data, you know, get them up and running on the platform really quick, and passing data back to them. So it's really those functions that we're looking at, as well as some configuration whilst they're on the platform. And yeah, we're making really good progress, and that's quite well, look, I'm a technologist, so I like to get people out of the process completely and automate everything, and so that we know we can kind of scale infinitely. So we're making really good progress in that. We'll be continuing to work on that in the coming months, but you know, we're confident we can cope with the workload coming in.
Second question on the technology front, I think, is there any patent protection over the technology, and in which markets?
Yeah, right. So we're in the patent process here in Australia and in the US. To answer the question specifically, I think there's probably a deeper question there about protection. I think our protection is really the investment that we've made, you know, the 5 years, the $30 million, and the huge amount of data that we've accumulated, which powers our AI and the intelligence. That's really our competitive advantage. And somebody who start out today, it's very, very difficult for them to reproduce that. You know, they give them years to be able to reproduce that, and a huge investment. And we're not standing still, right? So we are continuing to accelerate. It's a bit of a land grab in that way, because you know, the more we prove the results, the bigger clients we get, the more data we get, you know, which then, you know, drives the AIs and makes them more intelligent. So that's really the protection.
Yeah, look, I'm just going to add to that. Look, the digital transformation within this sector is here now. You know, anyone who's coming to the party now and trying to build a solution is going to probably be pretty late to the party once that's happened. So, you know, I think everyone recognises that the, you know, the transition to sort of automation, to QR codes, to handheld devices. I mean, we're here now, right? And I think that Credit Clear, without a doubt, is at the forefront of that transformation, certainly in this sector, and it looks to be, you know, in other sectors around the world. So it's an exciting time.
Very good. Next question for you, Andrew, just about South Africa and Tech Hub. Has it generated any revenue yet? And if not, when would you expect revenue to be generated?
Look, it has generated revenue, not anything significant enough to start reporting on, but it's absolutely generating revenue. But that's probably less a reflection of the performance of the solution. It's more about the staged approach in terms of the testing environment. So we're not testing it on huge volumes of work at the moment, due to the fact that we're trying to, you know, really iron out the solution and make sure it's a slick and easily used solution. A little bit similar to Australia. I mean, Australia had 7 years worth of developing Credit Clear for our market to make it as user-friendly as possible. So therefore, once you get a client or a customer to engage, they're very likely to proceed through to payment or set up a payment arrangement. What we're trying to make sure is going to work in South Africa is that whole customer experience from the moment they receive that message. And we're trialing it on tranche of debt to make it work before we start to roll it out on the whole portfolio at Tech Hub. So look, I'd be very, very surprised if we're not seeing significant revenue within next quarter. And that's what we've targeted. So look, it is certainly a slow progress, but I'm going to say we're 90 to 95% there in terms of development.
Right. I'll just check in with the room at Bell Potter. Has anyone else raised their hand or like to pose a question?
No, fine on our end, Warwick.
Okay. Andrew, I'll leave it with you to wrap up.
Yeah. So once again, I just wanted to say thank you to all the investors and all the interested stakeholders in the business. We certainly feel very privileged that despite the fact there's been, you know, sell-offs in the tech space throughout the last 12 months, that many of you have stuck with us. You know, I think that, you know what, this year's outlook, I'm very confident that the business now, compared to what it was 7 or 8 months ago, is extremely stronger. It's profitable. Our outlook in terms of growth is certainly there, and I'm confident that you'll be rewarded for staying with us and loyal. So thank you to the investors. Thank you to the staff for all your efforts over the last 12 months. And I'm excited about what the next 12 months is going to bring.
Thank you.